In June 2013, the Australian Tax Office estimated that the total balances for all self-managed superannuation funds in Australia is now $495.2 billion. It's clear to say that self-managed superannuation funds are now not only the flavour of the month, they are the force to be reckoned with as they now control so much of Australia's wealth. Today I'm here with my colleague David Glen, Special Tax Counsel from TAL, and we're talking about Regulation 4.09 and how it relates to the trustee of a self-managed superannuation fund. David, thanks for talking today.
Only a pleasure, Drew.
When did Regulation 4.09 become amended and what does it do now?
Well, Regulation 4.09 came into effect in August 2012, and it requires trustees to consider the life insurance needs of their members.
Many people don't consider getting life insurance in their self-managed fund, and often they forget when they transfer from a retail fund that they need to transfer insurance as well. Why is that important?
Well, their risks change and they lose the benefit of the insurance cover they had in their retail funds. And it's interesting that according to government statistics, only 13% of SMSF members have any form of life insurance cover within their SMSF. The way the government has structured 4.09 and this amendment to 4.09 is a very interesting one. Firstly, this requirement to consider life insurance needs is an operational standard. A trustee who recklessly or negligently breaches an operating standard is up for a penalty of $17,000 potentially. And not only that, this requirement of 4.09 is also a covenant.
David, can I just interrupt you there because you've said the word covenant. Now that's an unusual word, but it has very significant legal ramifications. What does a covenant work with SMSFs?
Well, Drew, a covenant is an undertaking that the trustee makes to the members of the fund.
Right.
And if the trustee is in breach of that covenant, then the members have a right of action against the trustee. Now, in this situation, this is a covenant, and therefore, if the trustee fails to consider the life insurance needs of the members, those members can bring an action against the trustee for any loss they suffer as a result of the trustee's failure to consider the life insurance needs.
So, David, if we're looking at the responsibilities of the self-managed fund trustee, if a penalty is imposed, is that just a penalty where money is taken from the super fund to pay the penalty, or is it something more personal?
Yes, it is something more personal because the trustee has to meet that liability from his or her own assets rather than the assets of the SMSF.
David, that's a significant change to the environment, and I think self-managed superannuation fund trustees need to be very aware of that. Regulation 4.09 changes the environment and imposes a personal obligation on the trustee. It's not something you can ignore.
And trustees who ignore this new requirement under Regulation 4.09 ignore it at their peril. And unfortunately, there is a myth going around in the marketplace that you can simply address insurance needs by a one-line item in the investment strategy saying that you have considered those needs. Yeah. My view is that the regulation requires much more onerous due diligence by the trustee in ascertaining the life insurance needs of members.
David, let's take that point one further. I've got a document from the regulator from ASIC dated April 23rd, where ASIC states, the regulator's investigation has found that only a small number of investors have received an insurance recommendation before they established the fund. The regulator then went on to say, providing general or educational information in an advice document is not a substitute for providing appropriate financial advice. So David, the next question is, when should a trustee of a SMSF start engaging and actually thinking about what are the insurance needs of their members. Can they do it after the fund is established, when they have their first meeting? What's your recommendation?
Well, Drew, my view is that the trustees should consider the life insurance needs of the members as soon as possible after the establishment of the fund. And this obligation is an ongoing obligation. This is not set and forget stuff. Every year, for example, the trustees should be re-examining the question of the life insurance needs of members.
And David, why would they annually have to go back and reassess those needs? Why is it not a set and forget option, as so many people today like to think it is?
I don't think it's a set and forget duty, simply because the obligation to consider life insurance is an ongoing obligation and therefore needs to be considered on an ongoing basis. That means regular reviews are required.
Let's talk about the processes involved. If someone who is a trustee of a self-managed superannuation fund wants to do it themselves, what should they do to actually start complying with Regulation 4.09?
Unless you as a trustee know the circumstances of your members, you cannot form a view as to what their life insurance needs are. So therefore, the trustee needs to ascertain the circumstances and provide some sort of documentary evidence that the trustee has considered these circumstances.
And David, for people who want a professional solution where an advisor would come and actually do that investigation themselves, prepare the documents, prepare the summaries, what would your suggestion be?
Drew, my suggestion is that the trustee should engage a competent professional, a life insurance advisor, in order to assist them in discharging this obligation under Regulation 4.09.
David, in relation to helping a trustee discharge their obligations, many of them use accountants, and of course everyone has to have an auditor at some point. Are accountants caught in Regulation 4.09? Are auditors caught with Regulation 4.09? What level of advice or awareness does a trustee have to be moved towards?
Well, Drew, let's consider the auditor first. The auditor is required to ensure that the fund complies with all the SIS requirements, including Regulation 4.09 and the obligation of the trustee to consider life insurance needs. Therefore, the auditor should be considering whether or not the trustee has discharged its duty under this particular sub-regulation of 4.09. So that's the auditor. Now, the accountant is the broader professional advisor, providing support generally to the SMSF client, SMSF trustee. Now, those clients, I think, will be relying on their accountant to guide them through all SIS regulations, including Regulation 4.09 and the obligation to consider life insurance needs. This means that the accountant is very much going to be relied upon to assist the trustee in complying with this sub-regulation of 4.09.
Obviously, compliance is very important, but there's something more important, and that is the reality that we are here dealing with the lives of the members of an SMSF, and their needs will change over time, and so should their insurance protection options be. This is the only way we can help people meet and offload the risks that they meet in their day-to-day lives. Of course, they're risks of death, of profound sickness, of losing their income for a period of time. Regulation 4.09 has changed the scenery. There is now a personal obligation and liability on the trustee. David, thank you for your time today in bringing some light on Regulation 4.09 and the new personal liability for the trustee of an SMSF.
Only a pleasure, Drew, and we should see this as an opportunity to add value to our clients so that we can help them manage the very important risks they assume in their day-to-day existence.